All right, let's go ahead and get started today. My name is Chinna Chun and I'm with NACB, the Consultants Training Institute. Before we get started with today's Around the Valuation World International presentation, we want to go over a few housekeeping items. First, to obtain CP credit, you must answer all the poll questions that pop up on your screen during today's webcast. If you have an AVW subscription, an AVW International subscription, you'll receive the CP certificates within 7 to 10 business days after today's webcast. If you have any questions during the webcast today, please use the Q&A feature, as those will be directed to the presenter. If you have any technical questions or questions about NACBA, please feel free to use the chat feature, as those will be directed to me. With AVW International and AVW, our regular AVW webcast, we try to cover all the emerging hot topics in the industry. However, we don't have time to cover all of them, so we do have additional links here for resources that you can visit to keep updated on some of the current events and topics that happen in our industry. With the Around the Evaluation World International webcast, we have Wolfgang Nies, Andrew Newman, and Pratik Shah, who are their editors, and Brian Jones as the advisor, and me, Chinda Chun, as a producer of the monthly webcast. And with the lineup today, we have Simon Rubinsohn, who will give us his expert insights on the economic update this time. Before we get started, I just want to go over some GACB news items. With the news items, we have our NACB annual conference coming up end of this year in December 12th and 13th in Las Vegas. So if you're interested, please feel free to reach out to us or your chapter leaders, who will have some additional information for you. And with that, I'm going to turn the time over to Wolfgang, who will get us started with our webcast today.
Yeah, thank you, Chanda. A warm welcome from my side as well. It's a pleasure for me to introduce Simon Rubinsohn. Simon is Chief Economist at the Royal Institution of Chartered Surveyors in the UK, RICS. He began a 15-plus year tenure with RICS after serving as senior strategist at Barclays Wells, where he was part of the team responsible for running the multi-manager investment portfolios and helping to develop structured products to widen client offering. In his current role at RICS, Rubinsohn is responsible for leading the organization's research and analysis of global property markets, including overseeing the suite of high-profile sentiment surveys. He is also responsible for providing economic analysis and forecasts to the RICS members and external stakeholders. Rubinsohn is a well-known economist who has been quoted in a wide range of publications, including the Financial Times and the Wall Street Journal. And he is also regularly appears on news programs as an expert commentator on economic issues. Warm welcome from my side. I'm looking forward for an interesting update on global economics. Having that this, I hand over the micro to Simon.
Wow, thank you, Wolfgang. And I am just going to share my screen. Can you see it, actually? Is that working?
Yep.
Yeah, great. Okay, actually. We're there, yes? You can all see it?
Yes, we can.
Great, okay. Well, thank you for the introduction. And it's always a pleasure to have these sorts of conversations because being based in one part of the world, obviously, while there's a lot of commonality about some of the big issues, it's really intriguing to hear and engage with people working in industry in other parts of the world. And while I'm going to lead the conversation for the next 40 or 45 minutes, I would really like it to be as interactive as possible. And, I'm very relaxed about having questions, but also hearing your thoughts, because I think it's a very much a two-way process in terms of learning and using these sorts of sessions effectively. So please, as I go through, do feel more than able to use the Q&A to post questions, and we'll hopefully, say not just questions, but your thoughts, and we can take them as we go along. Hopefully, there'll also be a little bit of time at the end, I would imagine, for any further thoughts. But I think it makes it for more interesting learning experience if we are as interactive as possible. So don't be afraid, and I want to learn as well what's going on in your minds and in your businesses as well, and the relevance of all of that in terms of the broader economic overview. So let me start. And what I want to do is, I suppose in broad brush terms, I'm breaking this session down into 3 parts. It's a little bit seamless, but I think there will be some sort of distinction between sort of just renewing the big picture. Where are we in terms of the global macro? Where are we in terms of policy? Central banks, governments, what's going on in terms of the dilemmas around those levers. And then let's think about the risks and the opportunities, and ideally how that all maps over to sort of business valuation and sort of the issues that the macro might actually throw out in terms of how we assess the likely path forward in terms of valuations. But again, when I get into that sort of terrain, I think I'm probably going to be learning more from you than you from me, but we'll see. I mean, hopefully it'll be as interactive as we can. So let me start with the very big picture. And I mean, I've spoken to you before, I don't think for a while, but I have spoken to you before in this format, or certainly in a format where I'm giving a broader context of macro conditions. And I thought so. What I thought I would do is start off by just looking at what's happened over the last 6 months in terms of expectations. And you can see there the purple line is how the forecasts have moved for 2024 at a global level, global growth, and that turquoisey line, what's been happening in terms of 2025 expectations. These numbers are coming through from Oxford Economics. It's a well-known consultancy. If you're not familiar with them, I mean, I would say a lot of their numbers are broadly consensus or capturing at least the direction of change. So this seems to be saying that growth has been a little bit stronger so far this year, and that seems to have led to upgrades to expectations. Next year, the numbers have followed, perhaps not 1-for-1 in terms of the direction, but you've still seen a modest upward move. And I suppose, if you're looking at this, you'd say, well, look, overall, that's a pretty encouraging picture. We know, and I'll come back to this, that growth, globally has been a little disappointing over recent years. There are some obvious reasons for that, but if you look back since the global financial crisis in aggregate, there are sort of, with a few noticeable pockets of strength, the overall picture perhaps has been more disappointing than it was prior to the global financial crisis. And there's been a lot of attendant issues that have followed that. So moving on from the real big sort of aggregate, the global GDP picture, what happens when we look at it in terms of, and this is using a terminology, slightly different definitions, Oxford Economics here, advanced and emerging. The IMF used something similar. It's not, I think they have slightly different categories, emerging and developing. But, what I wanted to do was capture the broad-based nature of the upgrade. So you can see, the forecast for, and I'm looking here specifically at 2024 because I wouldn't want to complicate the chart, but you can see what the expectation in terms of the advanced economies was for 2024 back in December. That purple block on the left-hand side, about 1%. You can see it's gone up to something between 1.5 and 2. The turquoise block, similarly for emerging, you can see the increase over the period. The upgrade has been a little bit more modest, but you can see it's affected both, pretty much everywhere we've seen slight upgrades. And it is interesting, but that includes the likes of, for example, China has been a market where, we actually saw a strong first quarter. and that has actually contributed to that slight upgrade for this year in terms of emerging, although there clearly are lots of ongoing issues around the potential for Chinese growth and obviously the politics of all of that as well, which I'm sure we will come on to. I suppose the final one of these charts that I wanted to just touch on is, and I mentioned China, but I want to look at individual economies, and just so that we can just have a look at what the numbers might look like when we drill down a little bit further. So you can see here, I've gone back to 2024 and 25, but I haven't given you the original, the sort of end of year forecast to keep it, but I wanted to keep it relatively straightforward. And you can see that block on the left-hand side is the advanced economies, the block on the right side, some selected emerging economies. Generally speaking, next year is seen as being a bit stronger than this year, certainly in the advanced economies. In the case of the US, there seems to be a bit more of a slowdown. The US and India, I should say, the standout performers from the particular countries I've selected. I have seen some sort of comments that perhaps the US number for this year might be slightly pushed back a bit after recent data points. Perhaps 2.5 might be a little bit high. But nevertheless, we're sort of looking at still a reasonable base across the advanced economies for next year around the 2% mark. I say in a historical context, you might say that is unspectacular. It's more solid, but nevertheless, I think directionally, it's on the right side than the wrong side in terms of economic activity and what that means in terms of the environment for profitability and by implication, I suppose, valuations as well. So, I mean, overall, I would say the picture is, looking out is, not, we're not talking about a significant uplift in growth, but we are talking directionally about a pickup. Particularly, and we'll come on to policy levers, but given where policy levers are at the moment, they're likely over the time to increasingly be growth supportive to a degree, and that I think will pave the way for a little bit more say consistency in terms of the trend in economic activity. You can see on the right hand side there, the emerging markets, it is India. The China numbers look okay, but again, one's got to think about the context of Chinese growth, in recent years being, or certainly pre-COVID years being sort of nearer 7% a year rather than 4 to 5% a year. So that still is a material markdown. So I suppose into that really is the sort of the growth environment. And I think as we move through the presentation, we're thinking about where we are in terms of the mood music around economic activity. It is edging towards the positive, but not without a lot of questions. And one of those key questions is really going to be about inflation. Now, this is another one of those Oxford economic charts I've actually lifted, so I'm quite open about this. But I thought it was an interesting chart. And what it's trying to do, and it's focused simply on advanced economies rather than emerging, but it's looking at inflation and inflation volatility in 20-year periods. And it says since 1320. Well, I'm not going to verify any of that. And in truth, I'm not overly excited about the historical context, although I think it is quite interesting as well, looking at those numbers. But what I'm particularly intrigued out is looking at the comparison between 2000 to 2019, which is that diamond at the bottom there, just by the 2% mark. So you can see that, in fact, it's the lowest in terms of volatility, and while not the lowest in terms of inflation, it's pretty close to that 2% mark that most central banks have in mind when they're thinking about targets for inflation and policy settings. And I've grafted on the first 4 years of this decade, 20 to 23. You can see it's a diamond, it's a triangle just to mark it out, and a bit bigger. So you can see where we are. You can see the average inflation rate, as we all know, has been higher over recent years for good reason. Pandemics, wars, there's enough reasons. We can all think of them. But so we're not surprised where that diamond is now. And I suppose what the interesting question is are we going to be moving in the right direction back towards where inflation was in 2000 to 2019? And I'll be very interested in your own sort of thoughts on this, your own experiences. But there certainly is some encouragement around some of the news flow on inflation. There's no doubt about that. We hear in the stories that the direction of travel does seem to be pushing inflation down. But I think it is, when we think about sort of inflation over the period, and these are 20-year periods. If we think about that 2000 to 2019, I think it's fair to say there are significant differences between those first 2 decades of this particular century and the last 4 years, and indeed the political narrative around that as well, which does give me thoughts, food for thought as to whether it is realistic to think about inflation going back into that area. And I suppose let's start with what are the issues? Well, I suppose we are dealing with a more protectionist type environment. All countries are sort of thinking much more from a nationalistic point of view. The rules-based sort of trading system doesn't seem as secure. Now, there may be some, some good reasons why countries have reacted in the way they have. I suppose if you think about the whole globalization agenda and the role of China in that narrative, the way that the Chinese products help to suppress inflation across the globe. They may have had other consequences as well, but what you had there was that the parameters around which inflation was anchored at a particularly low and stable level. So as we move into this very different world of much more sort of economic nationalistic type thinking, where question marks over the free trade environment are raised, and perhaps rightly one questions whether trade was ever that free, but we are in a different sort of environment. And I would add on that, I would graft on that a big government environment. And I think that that is the case again, Europe, in the US, and again I obviously am, and in other parts of the world, I think government is playing a bigger role, and even sort of perhaps traditionally right of centre governments who perhaps historically might have been seen as being more in favour of small government are perhaps behaving in a different way in this period. So given all of that, I have some question marks in my mind about whether we are going to see a rerun of inflation in the first 2 decades of this century. So that getting back to that 2019 diamond, I wouldn't profess to say what the average will be over the course of the second 2 decades, because I think it's such a tough call and there's so many factors. But I wouldn't be surprised if inflation were on average a little higher, and I wouldn't be surprised if there was a little bit more volatility. I know you've been reminded, but please do think about any thoughts, think about posting any thoughts you have on any of these issues. And if there are questions, again, put those through as well, but really would like your involvement in this. Going back to or continuing with the debate about inflation, I mean, I think that we're aware that if we drill down, services, and I'm sure this is not a surprise to any of you, services are the main driver of inflation across major advanced economies. That I think is being pretty well discussed everywhere. And even if service prices typically lag what's going on in terms of energy and goods price inflation, I think that that retreat to target is taking a little bit longer than normal. So there's a bit more going on now. What's going on in the US and Europe? They're different trends, and I don't think one could talk about particular factors across the globe in terms of the service sector. But I think overall, what you are seeing is a more resilient trend there, which is raising question marks again, not about the direction of travel, because I think that we can see where it's going, but how quickly it gets there and how easily it stays there. So I put that last bullet point in there, which I just thought it was worth just reiterating. Labour markets are still tight, and I think that yes, there are some signs, and there's always a lot of noise around figures in the US. The payrolls or data always brings up a lot of noise, and of course there are sometimes indicators within that big number which will point in different directions. There may be some signs that the labour market is slowly beginning to ease. It's overall tight, but it's slowly beginning to ease. And if as it eases, wage pressures will gradually moderate, and if that happens, then service inflation will also likely moderate. But what I say, that speed of return to normal, I think, will be slow. And look, you may get some, you may well find you get a positive surprise, but I always think just round the corner, when you've got labour markets this tight, the risk is that we will find that you could get disappointment as well. So the inflation picture is edging in the right direction, but I do think that longer term view is quite an interesting one. How anchored inflation will be as we move forward. And obviously that has a big, resonance when it comes to policy. Now, you may well know, I mean, you've been probably following the news, and you'll have seen that some central banks are, getting quite, or getting quite willing to start, cutting rates. We've had the ECB, so quite a big central bank, quite an influential central bank, cutting rates by a quarter point just a couple of weeks back. We've also had, in Canada, the central bank cutting rates. We've had Sweden, Switzerland, Hungary, Czech Republic. So there's been a bit going on there in terms of rate cutting, and that is, perhaps a signal that things are beginning to move. On the other hand, we all know, I'm sure that certainly those who are based in the US, that the Federal Reserve is very much at the moment sitting on its hands. And being based in London, I'm very much aware of the Bank of England's position. And it's worth adding that the interpretation of the ECB move was as a hawkish cut rather than a dovish cut. So, we're cutting, but we're mindful of the risks around this. We're not sort of going gung-ho. And I think that was actually picked up a little bit in terms of the reaction in markets. So if you look at this particular slide, and I've got government bond yields, and I've picked out USA, UK, and Germany. Obviously, if you look at some of the emerging markets, the trends are a little different, but I've concentrated on the more advanced economies here. And what you can see is that the 2-year yield, which I'm sure you're all aware, effectively is meant to reflect what interest rates will do over a 2-year time horizon. They've budged a little bit, and there has been, since the I would say since the ECB move, I would add since some better inflation numbers in the US, that we've begun to edge down just a little bit. But you can see that they're not, bond markets are not getting carried away with expectations about rate cuts over the next couple of years. This is meant to reflect an average rate over the period. And it doesn't sound to me, looking at this, that markets are overly optimistic about the scope to ease. And that doesn't mean interest rates won't come down, but what are they likely to average over that period? I think that's worth bearing in mind as we try and work out, what the implications are more generally, and how this will play out in terms of any discount rates we're using when working out valuations. I think that there's the money markets sort of and bond markets. It's fair to say there's always a bit of volatility there. Perhaps next week we get another piece of information and markets go back a bit, or they go forward. Similarly with shorter term money market expectations, there's always a fair amount of volatility and interpretation of data, and that's totally understandable with markets. But it's quite clear from this, and indeed, and I've just gone back to that last Fed meeting, because I use the Fed a lot in my analysis, simply because of its role as the major central bank. And while it's possible, as we saw with the ECB, to cut rates when the Fed isn't cutting rates, the Fed does provide effectively a global benchmark on the cost of money. So it's always interesting to follow the deliberations of the Fed and Fed members and where they think rates are going. So what have I got here? Well, you're all probably aware of the dot plot that Fed members put together for to capture their expectations around where interest rates are likely to head. And you can see that, in case you aren't familiar, they give us an end year, and then next year, and indeed an end the year after, and a longer run view on interest rates. And look, let's be frank, these numbers will change. They will reflect the news flow. And if the news flow changes, expect there to be a change of direction. So what have I've just given you a bit of a feel here by showing you what they were saying in March against what they said in June, so the last Fed meeting. And you can see that, certainly for this year, there's been some backing up. The dot plot was pointing to 4.5% Fed funds, which would have been 3 quarter point cuts effectively. It's now sort of talking about 1 quarter point cut. I know that money markets are a little bit more positive. They're thinking maybe we'll get we'll get a sort of late summer September cut and then an end year cut. But at the moment, this is very febrile, and it will very much depend on the incoming, as I said a number of times already, incoming data flow. The other thing that I think is interesting, and again, it goes back to when we're thinking about sort of discount rates and business valuations, amongst many other things, is what is the new normal for interest rates? Where are they likely to settle? And we looked at those 2-year yields just before, and the European yields, or certainly German yields, perhaps historically because of the way that the ECB and before it the Bundesbank used to focus almost single-mindedly on inflation, tends to operate with slightly lower yields. But even there, we're not looking at rates understandably going anywhere near what we've grown familiar with. And here, if you look at the dot plot from the Fed, end 2016, they're still pointing to, sorry, end 2026, apologies for that, we're still looking at rates in excess of 3% marginally. And in the longer run, actually not that dissimilar. And again, that comes back to this idea of, is the long run new normal for interest rates around 3%? I would certainly say that would be, something that I wouldn't demur from. It's something that I've been arguing for a while. I think somewhere between 3 and 3.5. And that doesn't, of course, mean that rates won't go lower, but they'll only go lower if economic conditions warrant. We have, and I know you all know this, but we have grown accustomed to rates at significantly lower levels for a period of time now. And I think that, we may go down back there, but I think there will have to be a very good reason for that. And I think when we think about business decisions, we need to think about what is likely to emerge in a realistic set of macroeconomic circumstances. Now, just sort of almost finishing off this particular thing about interest rates. And again, I remind you, I'm always happy to have any thoughts on any of this, because I'm sure your insights are just as valid as mine, so don't be afraid of saying that. But what I've actually turned to is here the recent report from the OECD. And this is not, this is a more general comment on interest rates. It's not focused specifically on the US or any advanced economies. But I thought it was just worth running through this. So, they say that monetary policy more generally needs to remain prudent to ensure underlying inflation pressures are durably contained. And I think that really chimes what I've been saying, that, inflation, looks like it's moving in the right direction, but it's unusual actually to have the economic environment we've been through over recent years and have labour markets so tight. So while we're not in uncharted territory, I think we've got to be mindful of risks that inflation might become again a little bit more embedded. Some people on this call, not many I suspect, but I sadly am old enough to remember inflation episodes in the 70s and 80s and how it becomes very difficult for central banks to regain control. So that's something I think is very much at the back of a lot of policymakers' minds. They do acknowledge, the OECD does acknowledge, the scope exists to start lowering nominal policy rates. So we're seeing that, yes. I mentioned the central banks that have begun to move in that direction. But critically, the policy stance should remain restrictive for some time to come. So again, don't expect, big cuts. And in a sense, what that's sort of saying is it's very much dependent on inflation. Think about what the real rates are. Don't expect real rates to become too compressed. Now, my view, and I've just added this on at the bottom here, is that the easing cycle will be gradual and more prolonged because it's reflective of a normalization of monetary policy rather than a response to a growth scale recession. Now, again, things may change and there may well be a shock. There's enough going on in the world at the moment that could actually upset the apple cart of recovery, and we could get a growth scare. But at the moment, central banks to me seem to be in the process of normalization, and that means it's more of a slow burn than aggressively pulling the lever. And there are good reasons for that. I understand that a lot of businesses and consumers want faster action, but I do keep going back to that, that risk about inflation becoming embedded. So getting it right here. And I would add, not overdoing the tightness. One doesn't want to be too slow to start easing policy. And I've heard that argument that central banks were too slow to tighten, and now they're going to be too slow to ease. I'm not sure, but I believe that at the moment they're too slow to ease, but I can understand from a business point of view, you might come to that conclusion. And I think the other thing to watch for is that increase in inflation volatility. I highlighted it earlier, and it would also argue for a more measured pace of rate cuts. So, that is very much the inflation story and the interest rate story. When it comes to other challenges, there are numerous of them. And, I've highlighted, I'm going to come on to this one in a minute. But I think, if we were to think of the big issues out there, we can talk about that might affect the global economy, might affect business, activity, might affect indirectly, therefore, business valuation. I mean, geopolitics sort of stands out, and I won't go there. I suppose the environment for international trade and capital flows is going to be an issue that may well be something that is a factor. And then the sort of the third element, and I'm going to come back to a question here, so I've on inflation in a second, but I'll just finish this bit off, and just looking at the sort of the issues around how governments manage their fiscal positions is a third factor. So geopolitics, I suggested, international trade, capital flows, and then what the sort of the overall fiscal picture. I think that what I would highlight here, and this is just a chart looking at from the OECD, but effectively trying to capture in aggregate in the OECD area government deficits as a share of GDP. Sorry, government debt as a share of GDP. Apologies for that. And what you can see on the left-hand side is that period before the financial crisis. Whichever country you're in, you may not find that sort of 70% chimes, but it will depend on which country you are in. That's an aggregate across the area. You can see what happened after the global financial crisis, 2010 to 2019. And then you can see the COVID era issues. And, we're hovering, including a forecast there from the OECD, hovering in between 100, well, around 110 to 120% of GDP. Now, these are big numbers, and it matters more now than it mattered perhaps a few years ago when interest rates were low. Obviously, debt servicing costs have gone up significantly, putting additional burden on the public purse. And of course, I mean, I happen to believe that there's some medium-term, pretty big pressures about to, perhaps some near-term and medium-term pressures, I say, which are pointing in an upward direction in terms of debt for government. So they're going to have to think about what issues they want to prioritize. So I've highlighted here demographics. Now, that isn't, depending on where you are, demographics is more of an issue than others, maybe more of an issue in Europe, maybe more of an issue in Japan. But where it is an issue, it is, potentially quite a significant one, which I don't think, governments have necessarily got, thought through what the full range of costs are related to that. The geopolitical issue is manifesting itself on the defense side. So defense spending pressures are clearly going up. Climate change mitigation, the IMF's done a lot of work around this and about the likely cost, particularly if governments rather than the private sector is going to play a big role in all of this, as has been the case hitherto. Some really big costs there. And I talked earlier about big government politics, and I think that is still about inflation. I think it's just as relevant when it comes to sort of financial liabilities. And again, I say that sort of transcends the old left-right divide. I think that this whole sort of focus around economic nationalism, for good or bad, more individual self-reliance, points to sort of increased spending and perhaps some focus on lowering taxes as well. But the overall balance in that is that there's going to be more debt. So we've got some real big challenges there for governments. Now, before I move on, I did get this question about how people are being affected about inflation and whether it is broad-based. I think that again, it's very much country specific. But if one thinks about the sort of factors that have been driving inflation in the recent past, and that's obviously begun to ease more recently, but the sort of factors that have been, and I'm going to the sort of factors that have been driving inflation, they have been issues to do with energy, other commodities, food, and that obviously puts a bigger pressure at the lower end of the spectrum. I suppose more recently we've had that shift towards higher service sector inflation, and you could say that is more balanced because the sort of the sort of the cohorts of the population that tend to be more reliant on those sorts of services will perhaps be perhaps more middle and higher income cohorts. So I think there's a bit of a mixed picture around this, and obviously it will depend on individual countries. But there's no doubt, and I think we're seeing it in terms of perhaps some of the politics of what's going on globally at the moment, that people feel very unsettled, and perhaps people who are perhaps more vulnerable, but feel particularly unsettled and are looking for answers, which politicians may or may not have the answer to. But I think there's a bit of a mixed picture. So I wanted to just move on from sort of those challenges, and they're multifaceted, but I did think this issue around debt and government's a big one because typically when we start hitting numbers above 100% of GDP on debt, one perhaps sends a few sort of warning signals about how governments are going to manage things going forward. I wanted to say a quick word on the dollar, and this may affect you in different ways depending on where you're based and how to the extent to the currency is relevant for you. This chart just looks, and again, I've taken a chart this time from another one from Oxford Economics, and you can see here it's just looking at the real effective exchange rate against the trend. And you can see that the dollar's enjoyed a pretty good run, and you're probably all very familiar with this. I don't think there's any surprises here. I suppose the question is what's going to happen next. And when I look at the fundamentals and I look at the way that the Fed's managing monetary policy, the US economic performance against And perhaps, and I mean, I know that the US has a big election coming up, but perhaps, in the context of the European elections, one might view the US as perhaps and arguably a more stable political environment than perhaps in Europe. I'm sure some people might take issue with my comment there, but I mean, it seems to me likely that the dollar will remain. If it was left to the economics of it all, the dollar would remain reasonably well underpinned going into 2025. But whether or not policymakers make a call about whether or not they believe that this is something that they want to see, and whether it's in the interests of their economy is another issue. So something to think about there in terms of the dollar. So I want to now move on. We're moving on in terms of timing, of course, as well. And again, I again ask to you to put any questions you have in the Q&A function, any thoughts you have. I wanted to look at the upsides, potential perhaps to the global economy, because early on we were talking about sort of it looked, a recovery, but it's solid. It's not spectacular. There's quite a few risks associated with all of this. Interest rates coming down probably over the next sort of 18 months, but not dramatically. We're going to have to get used to the new normal. Where could the surprise come from? Well, this has been discussed many times, but we're aware that during the pandemic, some people were built up quite a significant nest egg. There was a lot of money dispersed by governments. People weren't able to spend money in the way they had been previously. So what's been going on? Well, this is data from the OECD, and what it shows is certainly over the last 2 years. So you look at the chart on the right first, you can see the US has been one of the areas where, as a percentage of disposable income, you've had the most dramatic rundown of excess savings. And I think that might help to explain the relatively strong economic performance in the US. And you can see, I mean, I wouldn't say characterize all European markets in the same way, because the numbers for Italy also look relatively strong in terms of the rundown in savings. But if we then move to the chart on the left, this is the estimate from the OECD of the excess savings that remain in place the middle of last year. So it's not bang up to date, but it still gives us a broad-based feel of where, if the right conditions emerge, we might see another leg to spending supporting growth. And notwithstanding that rundown in the case of the US, we still have relatively high, still almost 10% excess savings as a share of disposable income. So still potential there. And you can see the countries further to the right that are in arguably stronger positions. I mean, part of the reason for the difference in this is the way in which the pandemic fiscal support was allocated. And in the US, it was actually more broad-based and additional, which, I know not, as is the way with all these issues, there were question marks on whether it was the right response, but it has actually helped pave the way for a more significant layer of support for the economy as those balances begin to be run down. If you look in Europe, actually, a lot of those balances are actually with those cohorts of the population who have higher incomes and by implication lower marginal propensities to consume. So, I mean, I suppose it might be the case that some of those high numbers in Europe won't actually diminish. But what I would say is this is a potential area, and I stress, interest rates may not be coming down dramatically, but they are going to begin to come down. So some of those higher savings rates that were on offer previously for people who were putting their money or holding their money in cash or near cash, the returns will be diminishing, and that might be the trigger for a lot of people to think, or households to think, is this something now we want to think about utilizing? So that is a potential, a support for the economy over the next year or two. I think the other thing, and I suppose this is going to be my final point, but I've got a few slides around this. But I mean, I suppose, fundamentally, lifting economic performance is going to be the big game in town in terms of the upside opportunity. So we talk, there's a short-term gain that might come from running down those savings, and I'm sure you can all think of other reasons why growth may possibly surprise on the upside, but fundamentally lifting that productivity rate is going to be a fundamental, really a critical issue. And I suppose it's fair to say, look, countries' performance on productivity differs, but again, post the global financial crisis, I think most countries have experienced more disappointing levels of productivity than prior to the global financial crisis. It does seem to have been a point in time that has triggered a change in behaviors. Now, I've got this first chart here, which I'm not sure is terribly enlightening, but I thought I would put this up because it shows, and again, it's an OECD chart looking at gross expenditure on R&D. It doesn't suggest that there was a fall off after the global crisis, but it also doesn't suggest that there's been very much of an uplift either. So, money, and I suppose if I look at the numbers, and again, it only goes up to 2022, so apologies for this. But even looking at the whole period, we're talking about very marginal changes over that period. So globally, gross expenditure on R&D is generally pretty stable, and there's been a lot of discussion, and I've sort of been party to some of it. Thinking about how what are the conditions around which this can actually be increased? How can we get more money committed to R&D, and to what extent will that be effective in actually helping to drive up productivity? I suppose a lot of faith, and I'm going to come back to a question I've had here on economic growth in the UK specifically in a minute. But a lot of faith is, and perhaps too much faith, and again, I would be really intrigued in your thoughts, is being placed on, on AI. And I mean, I'm sure you're all probably investing in, the whole AI story on Wall Street. I mean, quite how much of the gain has been linked to AI related businesses is quite phenomenal. Of course, the other side of that is that those same businesses, when they've disappointed in terms of their results, have been very heavily punished. So there's a real marker here. There's a lot of excitement about it. There's a lot of businesses that are sort of refocusing themselves to sort of be part of the AI story, but where they are not delivering, there's been very swift retribution on the stocks, if nothing else. What I think, I looked at this survey from Deloitte's, and I was quite surprised. This is a recent survey. It was come out this year of businesses, and I was quite surprised that the response to the question of over what period of time is generative AI likely to transform your organization was so short, 1 to 3 years. That's something that does surprise me. I thought perhaps we might see it being applied over that period, but I mean the idea of transformation. So I think there's a lot of excitement on the part of a lot of business leaders that this is actually going to come through quickly. And it may be that us economists, or me as an economist, perhaps I'm just a bit too slow in thinking about how this will play out. My sense is it will take, for it to really make a meaningful change, and to use the word transform your organization is something that, I would be surprised if it came through quite that quickly, although obviously there's a lot going on. I mean, the other thing that I want to point out here is some work that the OECD has done, and they demonstrate in their analysis just how concentrated the applications of AI as they are in larger enterprises, and how a lot of smaller businesses really aren't, ununderstandable. The SME sector is inevitably going to be slower to adjust to these things, to fund these transformations. which again makes me question, whether that 1 to 3 year time horizon is realistic. Some work done by another consultancy, Capital Economics, actually concluded that they felt that AI could lift productivity growth by up to 1.5%, but that was in the decade following widespread adoption. So there's different questions here. How quickly is it going to make a change to your organization? And then, to what extent is it going to have a wider impact on the economy and economic performance? And before I take these final questions, I'm just going to have this last slide. And I went back to Oxford Economics to look at, what their medium-term growth forecast or growth, what they describe as growth potential. These aren't forecasts, but they look at the key drivers of what is long-term growth potential around capital stock and labor supply and total factor productivity. And I just reviewed the numbers they had in place. And when I looked at the numbers, and what I haven't got here is the latest forecasts, but this is the 10-year view, potential GDP. And actually, these numbers are not very different from the expected growth performance over the next year or so. And indeed, they're not very different from the growth performance if you look at the 2000 to 2019, the pre-COVID period. So, I mean, again, it makes me question, whether there really is, is AI, and we saw it with the whole internet sort of issue at the turn of the century, but is how quickly is AI going to feed through into potential growth? And is it really going to lift productivity? There are obviously some challenges around its applications in terms of what it means in terms of labour market skills, etc. as well. And I think, that's quite interesting again about, what it means for valuations and business valuations, because ultimately, we're talking about an environment that interest rates aren't going to fall, certainly back to where they have been in the recent past. To get valuations up or to maintain high valuations, potential growth is going to be, and productivity is going to be absolutely critical. So I see upside here, but I'm just a bit cautious about how it's going to play out and the timelines around it. Now, I've got a couple of questions that I wanted to just quickly look at. And one of them was specifically about the UK. I think the UK certainly, has a lot of the issues that I've been, challenges that I've been discussing here. One might add that obviously some of the policy making in recent years has been fairly volatile. I'm not going to make a judgment on any of them, the major issue perhaps which you might think about, which is obviously the decision to leave the EU. But a lot of the policy making and the politics around that has been particularly volatile. Certainly a period of stability would be helpful in terms of the political situation, but I don't think that necessarily answers the question. Investment has been low. I mean, to be fair to the current Prime Minister as Chancellor, he did try and introduce measures to try and stimulate investment, which has had a business investment, which has had a short-term impact. But there are still some challenges to maintaining that. Business investment remains historically at a low level. It's not the answer, but it's part of the answer. And I haven't talked about skills. Skills is a global problem again, but I think it's one that the UK has a particular challenge with in a number of areas. So I don't think if I had a magic, bullet for the UK, I don't think I do, sadly, but I think a stable period of government would be a help, and a real focus on some of those important areas around getting business investment up on a sustainable basis, looking at the skills issue, thinking about getting things done as well. And, whether the new government, whoever it is, has the ability to address some of those issues that lead to inertia, whether it's around planning, infrastructure issues. I would think that those sorts of factors would help. Quickly moving on to the next question. Well, yes. So this is again about AI and how will it actually make effective change in the economy and what areas? Well, as I've sort of implied, I don't think this is going to come through terribly rapidly. I think that we are seeing changes. Of course, we're seeing changes now as we speak, and people are getting familiar with whether it's Chat GPT or whatever else. And that's just a very simple example, of course. These things are going to work their way through, but I'm just dubious about the speed and the application. One of the consequences also of all of this is it's likely, and I think we saw with the last round of technology innovation, it puts a premium on the skills for people who are able to access and use the technologies, which is not necessarily a bad thing. It creates incentives, but it also brings with it challenges for those people who don't have those skills. And at the moment, that seems, when we talk about tight labour markets, that seems perhaps not the major problem, but I think it's possibly something that we will need to think about moving forward. Again, I'd be very interested in any thoughts about how, from your business point of view, how you think AI might apply, and whether you believe it has the ability to transform your business and indeed other businesses that you work alongside, and by implication then productivity. But yeah, I think it's going to be a pretty slow burn on this. So I think that unless there's any other questions, but obviously if there are some that people want to take offline, they can always email me directly at RICS, and I'd be very interested in your thoughts. That's srubinsohn@rics.org. If there are no more thoughts or questions, I'm going to hand back, I think, to Wolfgang?
Simon, I can assist with that, but there was a quick question in the chat. I don't know if you saw that just popped up. It says, I would like to ask a question about the real estate market.
Oh, I missed that one. Sorry.
Oh, sorry. I can read it real quick. Do you think that the fall in the real estate prices, for example, in Europe, has bottomed out, even if interest rates do not fall any further?
By real estate, if we're talking about commercial property rather, because I think obviously when it comes to residential, the picture's been the fallout there has been much milder anyway. But in terms of the commercial market, I do happen to think that real estate prices in aggregate, the picture has pretty much bottomed out. But I don't think obviously there's a huge sector skew here, and it won't it won't be a revelation that I say that one's got the difference between prime and secondary is absolutely critical, and what is defined as prime has changed. It's not what it it's not simply about location, but prime real estate has held up better through the downturn. Secondary, I think a lot of our office and retail still probably is going to labour, or some parts of the retail sector, and certainly quite a bit of the office. So I do think that the market in aggregate probably has bottomed out. But I think that within that, you're going to still see quite significant sector quality divergences. And probably it's going to be continue to be some of those alternative sectors which have the most appeal alongside logistics, because I'm not sure that overall, I think that the structural fallout around offices is anywhere near complete.
Great. Thanks for taking a moment to answer that. Looks like we're out of questions now. Simon, it's always a pleasure working with you, and thank you for joining us today.
Thank you very much.
And I also want to thank all the attendees for joining us, and anybody who's viewing this later on. Let's see, share this real quick. So our next webcast is scheduled for July 22nd. Hope that you all can join us. And yeah, thanks for joining us today, and hope you all have a wonderful week.
Thank you, Simon.
Thank you, everyone. Thank you, Simon.
Thank you.